Hello everyone and welcome back to Finance JCL. A warm welcome to all of my new listeners and also a welcome back to those of you that have joined me before. So the channel as a recap is aimed at new and intermediate level investors, and this series for today's show on free cash flow is kind of what I'd call the orange series, which is getting into the nitty gritty of good bits of investment knowledge that are vitally important to help arm you with the information you need to kind of value companies and invest wisely. So free cash flow today, which for me is an absolutely key valuation metric. Now for the show today I want to explain what free cash flow is with an example. I also want to demonstrate how you find or calculate the free cash flow figures, and finally help you understand why free cash flow is absolutely a key metric for successful long-term investing. So in order to articulate all of those things very clearly, I just want to bring it back to what is investing. So with investing, we will buy a business or portion of a business, and until the end of that business's life, it will generate cash, and all of that cash generated is what comes to the business owner. So the idea is to work out how much cash is generated during that business life, discount it to what that cash would be worth today, so not in 10 years time but today, and then one could apportion a value to a company and therefore decide whether to invest or not. So if we can review the historic free cash flow for a business over, let's say, the previous 10 years, we can actually find and have a good basis for predicting the future. Now, no one can predict the future exactly, so there's always risk involved. But if you've got the free cash flow for the last 10 years, you can look at how those numbers are behaving, you can look at the trend, you can see if it's very unpredictable or negative, taking those things into account. And if we can predict the future cash flows of that business, the cash it generates, we can therefore assign a value to them. And if we can assign a value to those cash flows, we can value a business that it shares. Now the video today won't go into that process because that's a slightly different approach, but it will tell you how to get those free cash flow figures. So there's a lot of credibility behind this free cash flow valuation approach. Warren Buffett, who has been one of the richest men in the world and is always in the top 3 or 4, who's with the Berkshire Hathaway company, and then Bill Ackman, who's also one of the legendary hedge fund managers. Both these guys say that if you can predict the future cash flows, because the whole point of investing is you chuck some money out, over a period of time you get some money back, so you want to predict those future free cash flows. If you can value a business and whether you should buy it, and in order to predict those future free cash flows you need to start somewhere, and the best place to start is let's look at the last 10 years, let's look what's happened. So we're about to find out how you do that. So calculating free cash flow, it's found on the cash flow statement. So as a refresher, there are 3 types of financial statements that companies will produce. The first is the income statement, the second is the balance sheet, and the third, which is relevant here, is a cash flow statement that shows cash movements over the course of the year. Now the line to look for is cash flow from operations, and you have to minus something called CapEx from that to get your free cash flow. CapEx is short for capital expenditure, so it's money spent on things like property and equipment and maintenance of the equipment. So it's something you have to calculate yourself, and that's the formula to do so. Now, as an example, let's say you had a gardening business, just to bring this to life a bit more. You go in there, you go out with your chainsaw, you cut the trees, you've got your mower out there, you cut the grass, that's your business. And let's say in a particular year you generate operating cash flow of $50,000. Now what could happen is you actually need to spend $10,000 of those dollars back into the business to, let's say, replace the chainsaw, because you have to buy a new one every year, or to service your lawnmower, and that means that next year you can generate that $50,000 again. So if you don't spend that $10,000 back into that business, you can't generate $50,000 next year. So you take that off because that's not free cash flow, you need to spend that. and you're left with a free cash flow figure of $40,000. So that is a very simple example as to how those metrics interact. Now, perhaps as a better example in real life is Apple. Everyone knows Apple. Now, full credit here to the Morningstar website, and I'll put a link into the description for this one. Now, Morningstar is a really excellent source of information when you're looking at companies to invest into. They do generally show, for the vast majority of listed companies, the last 10 years worth of key financial information, and you can see a screen grab from their website of Apple. And I've just highlighted in green the cash flow section. Now the cool thing here is actually they've calculated free cash flow for you. So you saw on the previous slide there's a formula. You don't need to do that. They've laid it out here so you can see the operating cash flow, the capex, and the free cash flow. And for those of you that are listening on the podcast version, one can see from 2010 to 2019 the Apple operating cash flow go from that $18 billion a year, going up, 37, 50, 53, 60, and 2019 it was $69 billion. Bit of capex spending, but not actually that much. So the vast majority is free cash flow. So the free cash flow in 2010, 16 billion, going to 30 billion to 41. You can see that ticking up. 2019, you're at approximately $59 billion of free cash flow. So we can see Apple's had tremendous growth in its free cash flow over a period of time, and that number now seems to be relatively consistent in the 50s and 60s billions of dollars. So if one was to try and predict their future performance, the future free cash flow, then that's kind of a trajectory could be developed or extrapolated from these numbers. So, great example. I would urge everyone, if you can use Morningstar to get some information, please do. It's absolutely brilliant because you get the full 10 years of history. Vast majority of other websites, you only get 3 to 5 years of history. And this Morningstar page you don't have to register for, so you can just click into it. It's all there for you, all the key information. So, moving on. So you might be saying, right, Apple have got all this free cash flow. Why is that important? Firstly, there are 3 things that they can do, and one of those is they can reinvest that free cash flow into the business. Now there's a good metric, which I'll make a separate video on, called return on equity, and that's a bit of an indicator of how well a business generates returns when it invests into itself in this way. So let's say Apple, when it's $50 to $60 billion of free cash flow, if they reinvested that into the business, they could perhaps make another $20 or $30 billion per year by reinvesting it. So if that was the case, we really want them to do that. So this is generally the best thing. If a business can effectively reinvest into itself and grow its business, the business becomes more valuable, and therefore in the long term the share price will increase, so you will make a good return as an investor. However, there are 2 other things that they can do with their free cash flow. They could pay a dividend to shareholders, and I'll make a video on this one as well to go into more detail, but essentially a dividend is a payment to the owners of a company, almost like an interest payment. It's perhaps a simpler way of looking at it. So Apple might decide to pay $3 for every share. So if you've got 10 shares, you'll get $30 in dividends, and then rather than the company reinvesting that money, it's in your pocket, and hopefully you do it through a tax-free investment account, so you don't have to pay tax on it, and then effectively you can then decide how to use that money. You could spend it, you can invest it in something else, or in fact you could reinvest it into Apple, and then if you bought more Apple shares and they kept the dividend the same, next time your dividend will be higher because you've got more shares. And then your dividend's even higher, so you can buy more Apple shares, and then your dividend's even higher next time. So you can almost use the compounding effect by reinvesting into companies, the dividends you've received, and increase your returns exponentially over a long period of time. So it's really important that business has free cash flow. And I'll just drop a link in to a video I've done on the compounding effect that demonstrates how powerful that can be. Now thirdly, the company could perform a share buyback. Now a share buyback is where it buys back its own shares in the free market. So that could be, let's say Apple had 100 shares, their company's divided into equal parts of 1%, 100 shares, and in the market they bought back 20 of those shares. There's now only 80 left. That means if they're worth, let's say, the $1 trillion that they're worth, or give or take today, instead of that 1 trillion being divided by 100, each share is worth 1 trillion divided by 80, so it's actually worth more than it was before. So as a shareholder, if a company's buying back stock on the market and people are selling it to them, your holdings are going to increase in value. So that's pretty cool. Now the danger here, and I'll make a video on this in more detail as well, is that if a company buys the share at a price of X, or let's say 100, if the actual underlying value of the company is less than 100, then that's not efficient, because the management of Apple are buying back shares for more than the company's actually worth. Whereas conversely, if Apple was, let's say, worth $100 a share and they're buying them back for 80, so you're getting $100 of value for $80, then that's efficient use of money, that's providing value to shareholders. So it's very much key that the management of the business that allocates between these three methods of using free cash flow, they make the right choices, because the wrong choices, you reinvest in the business and you're inefficient, you're wasting shareholder value. So it's absolutely key to get that balance. In fact, Apple does all three of these things, so they're not mutually exclusive. You can do combinations, and they've been very successful as they've been doing that. So that's the end of the show for today. So in summary, 5 key things to call out. I think we've got a clear view of what is free cash flow, or sometimes called owner's earnings. That's the other term you may hear. And it should be now clear why that's important for investing, because you can value the future cash your business generates, so you can work out, is it good value in the stock market or not. It's now clear how to find or calculate that information, and Morningstar I think is the best place for that. And hopefully we've covered off what a company can do with their free cash flow, the 3 things. So all that remains is I'm going to actually produce a further show in the future, and this will be on the calculation of how you turn these free cash flow historic numbers into a prediction of future value. So stay tuned for that. That's going to be a very important programme. That's the summary for today. So in closing, free cash flow, very key piece of information. But please do hit the like button if you found this video or podcast educational or useful. I'd really appreciate that. And by hitting the like button, the popularity of it in the YouTube search engine will increase, so more people can find out about it. That'd be great. And in particular, if you'd like to hear and look at further videos as I release them, please hit the subscribe button, and if you hit the notification bell next to it, you'll get an alert when I release my next show. And I've got another 40 or so planned at the moment, so there's going to be plenty of information coming through, which I aim to break down into a very clear, digestible format. Thank you very much for being with me today, and I look forward to seeing you next time. Cheerio.